Hello guys, in last video we discussed about net present value and internal rate of return. If anyone not yet subscribed our channel, kindly subscribe, bookmark. In this video we are going to see the continuity. First we are going to see about investment opportunities with capital rationing. Suppose we are going to invest in a project, it gives us some profit. We are not going to invest our entire amount in a particular project. Rather than investing entire amount in a particular project, we are going to invest the part of the capital. So this is called capital rationing. Investment or raised, some part only we are going to invest. Because of that, there may be a problem for both NPV method and IRR method. Even though NPV is positive and IRR is greater than the cost of capital, we are not going to invest because of the capital rationing. There may occur some problem. Next, investment decision making under condition of uncertainty. Okay, so far we discussed that we are going to invest 2000. First year we will receive 350 and second year 500, third year 600. But in practice, first year we can't assume that we will receive 350 exactly. We may receive 350 or not. In second year we may receive 500 or not. So it's uncertain. Okay, we can't give assurance that we will get that amount. So in this para we are going to discuss about uncertainty condition. So far investment decision we discussed NPV and IRR. We discussed that we assume that it's certain, we think that we will receive that amount exactly, and no capital rationing. So we may feel that NPV and IRR is good, but after taking the account of capital rationing and uncertainty over the future cash flow, we can't use that same NPV and IRR. We have to make some probability. Whether we may receive that exact 350 rupees or not. So we have to take the probability of the both, we will get exact amount or not. Based on that probability method, there are only three methods they given: expected NPV rule, and then risk adjusted discount rate approach, and then sensitive analysis. First we are going to see about expected NPV method. Let's consider a manufacturer of electronic goods. A manufacturer from electronic goods decide to launch microwave oven, okay, for 5 years. He planned to manufacture a microwave oven for 5 years. The manufacturer believes that his cost and revenue will be based on only two factors. One is level of economy and then competition. So if economy is good, that sales will be more and they will get more revenue. If economy is worst, low, as COVID, no one will have the money, no one going to purchase the oven. So economy, based on economy, his sales may be increase or decrease. If economy is good, his sales will be increased. If economy is not good, his sales will be low. And next one, competition. If anyone is competitive to his product, there may be a split. Some people will purchase from his company and some people will purchase from opposite company. So that sales will be reduced. So if economy is normal, that probability is 40% sales will be occur. If rising economy means 60% of probability, in 100%, 40% will be sales will be in normal economy. If economy is good, 60% will be sales. Same in case of competition. If any competitive person is there, his sales will be 40%. If no competition means 60% sales. So we are making now probability. So situation rising economy, normal economy 60-40. If competition is there, 40. No competition, 60. In situation 1, economy is rising economy and there is a competitive, so 60%, 40% means only 24% of sales going to be occurred. In situation 2, normal economy and there is a competitive, then 40% will get 16%. Okay, in case no competition, rising economy means 60-60, 36%. Okay, 60-60 means 60 divided by 100 into 60 divided by 100 will get 36%. In situation 4, normal economy and no competition means 24% sales going to be occurred. Okay, so the cash flow estimate for 4 scenario. If situation 1 means investment is 25,500. If situation 1 means first year 6,000, second year income will be 8,000, third year like that. For situation 1, 2, 3 and 4 they given. If discounting factor is 10% means in situation 1 that NPV is minus 541. In situation 2, NPV is minus 6057. In situation 3, 14,148. In situation 4, 3938. So we know how to calculate net present value. If anyone not yet watched previous video, kindly watch it, then only you will know about how to calculate NPV, net present value, and what is discount rate. Okay, so now NPV for situation 1, 2, 3 and 4 is given. Now expected net present value means minus 541 into 24% plus minus 6057 into 16% plus 14,148 into 0.36% plus 3938 into 24%. We are going to add all these, so we are going to get 4939. So in overall probability we are getting 4,939. so we can invest in this project anyhow, that probability is positive. Next we are going to see about risk adjusted discount rate approach for net present value determination. So higher the level of risk, the greater must be the rate of return. It's true. For housing loan we are giving interest rate low. In case of personal loan, that interest rate is more than the housing loan, because in case of housing loan we are having a security, low risk, low interest. In case of personal loan, high risk, high interest rate. So higher the level of risk, the greater must be the rate of return. So in this calculation, first we have to determine the rate of return. So taking that risk is 0. If risk is 0 means what will be the discounting rate? First we have to calculate that one, and then we have to add the risk premium to that risk free discounting rate. With the new discounting rate we have to calculate net present value calculation. For example, risk free discount rate is 6%. Okay, first refunding the bank loan. For some bank we are giving loan means that risk premium is just 1%. That class of risk is very low, so risk premium is 1%. So 6 plus 1, 7%. Now new discounting rate is 7%. And then next loan is modernizing of existing manufacturing unit. So risk is somewhat higher than the previous one, but still it low only. So 3%, 6 plus 3, 9%. So as the class of risk increases, that risk premium also increases, so new discounting rate will be increased. So higher the level of risk, the greater must be rate of return. First we are going to find the risk free rate, then we are going to add the discounting, next we are going to add the risk premium, we will find the new discounting rate. With this new discounting rate we are going to calculate the NPV calculation. Third one, sensitive analysis for NPV determination. In this paragraph, they just given the outline. So this is the item: some plant and manufacturing cost, labor cost, advertising cost, raw material cost, sales revenue. This is original cash flow. This one is, if NPV is 0, what will be the cash flow? So here 800, here 934. How much percentage if we increase this 800 will become 934. If we increase 16.75 percentage, that cash flow for NPV 0 will be 934. Like that we are going to find out for everything. So this is called sensitivity. How much percentage we are going to increase, based on that how that cash flow will vary. This is called sensitive analysis. In this from this paragraph, they may ask what is sensitive analysis. Just a concept based question only they are going to ask. Okay, next, decision tree analysis for net present value estimate. Decision tree. So they given a tree diagram. This is not important for exam. This is not complicated also. Just for understanding purpose they given. They may ask some concept question only from this topic. So in this expected net present value, we choose that rising economy, normal economy, rising economy, normal economy. We choose it for only 1 year only we calculated. Same in this diagram, they are just explaining we have to take the all the years, all 5 years, so that only we will get an exact value whether we want to invest or not. For that understanding purpose only this topic is provided. So a project of 5 years, so same 25,500, 25,000, same that 25,500. If economy is rising, there is a possibility of rising economy is 10%. If possibility of rising economy is 10%, and that probability that economy will be normal as now is 90% for year 1. If economy is rising, that our revenue will be 9,000. If economy is normal, our revenue will be 6,000. Okay, again here if economy is rising economy, that probability is 40%, and the economy is normal state, there is a probability of 60%. If economy is rising, 40% means probability of 40% means that revenue will be 12,000. If economy is normal means that stable as normal means we will get a revenue of 8,000. Like that we are going to calculate year 1, 2, 3, 4, 5. Okay. In this topic they did not given the exact calculation, just they explain the concept, that's it. So from this tree diagram we are finding the present value, probability, and then expected value. So total expected value for 5 years is 111.9. So that project is positive, we can invest in this project, but without taking the all the 5 years, just we are making simple ENPV calculation, simple expected net present value, just we are calculating for only first year, means that it will be minus 313. So just they are telling you for expected NPV method, don't calculate only for the 1 year, we have to calculate for the entire period of the that operation cycle. Okay, first year alone if you calculate means it negative value, you may think that it's not worth to invest, but while you calculating for the entire 5 year, we are getting a positive value. From this topic, they are just telling you just to take all the years for calculating expected net present value to get the accurate result. Next we are going to see about non-discount cash flow technique. So far we have discussed about the discounting technique that or discounting rate. Hereafter we are not going to use that term or discounting factor. First one, payback period method. Simple. Project A, project B. In project A, first year you are going to get 7,500, second year you are going to get 20,000, third year 7,500 and then 3,000, that's all. In project B, every month you are going to, every year you are going to get 10,000. Your investment amount is 50,000. The question is, you will invest in project A or project B. So in project B, after 5 years only we are going to get the amount what we have invested. But in project A, in first 4 years itself, we will get that 50,000. In project A, in 4 year we are going to get the amount. In project B, 5 years only we are going to get the amount. So we will invest in project A only. This is called payback period method. In what rate we are going to receive the amount back, payback. In what rate we are going to receive the amount back is known as payback period method. So everyone will think that I need to receive my money soon. So project A. Next one, accounting rate of return method. It may be called as average rate of return or simple rate of return. There is a possibility of asking this topic in exam. So to compute this, the formula is average profit after tax divided by average value of investment. So average profit after tax, you know how to take average, but average value of investment means, for example, they given here sum of beginning and ending book value of investment divided by 2. Okay, if the investment of the project is 10 lakh, life of the project is 6 years. After 6 years, that scrap value will be 1 lakh. So we are going to invest 10 lakh. That scrap value means we are going to get back that 1 lakh. So it will be 9 lakh. And then average means we have to divide by 2. So 2 equal to 4.5. So average value of investment is 4.5 lakh. If there is a no scrap value means then investment will be 5 lakh. If no scrap value means 10 divided by 2 equal to 5 lakh will be average value of investment. So what's the advantage in this ARR method? Like payback period method, it's simple to understand and calculate. Entire stream of income, that entire stream of income for the period is we are considering. Okay, what are the limitation is we are just ignoring the time value of money, so it's a drawback. And then we are just taken the accounting profit and not the cash flow of the project. And there may be a consistency problem. If we are calculating the same method, same thing in some other method, we are not going to get the exact answer what we are receiving here. So there may be a problem of consistency. Okay, they given an example that life of the project is 4 years and every year we are going to get a profit of 52,000, 56,000, 59,000 and 57,000. We are going to take the average of these. So 52,000, 56,000, 59,000 and then 57,000. Average if you take divided by 4 means you will get 56,000. Okay, and then average value of investment. So here we are going to invest 16 lakhs. So investment is 16 lakh. They did not mention any scrap value. So divide by 2, it will be an average investment is 8 lakh. So 16 lakh divided by 2 is 8 lakh. 16 lakh divided by 2 is 8 lakh. So now ARR, average accounting rate of return method. So ARR of the project is 56,000 divided by 8 lakh in terms of percentage into 100, you will get a result of 7%. So that profit is 7%. So in this video, the important topic is net present value and IRR method only, and then what is discounting rate. And then these topics will be a concept based question only. From these topics they may ask in 0.5 marks just a concept based question. So mainly focus on NPV and IRR. Thank you for watching video. If anyone not yet subscribed our channel, kindly subscribe, bookmark.